And good afternoon, and I want to welcome you here to Finance Fridays. We are actually sponsored by the P.I.L.L method, and my name is Don Daniel. I'm the founder and creator of the P.I.L.L method. I'm also the host of Finance Fridays. So, got myself all tied up here. Let me get rid of this thing. Anyway, we've got some very good information for you today on Finance Fridays. We are looking at different types of loans. And if you know anyone with a high interest car loan, you know these car lots that say they can finance anyone, you want to call everybody you know and make sure that they see this, or you tag them right now, or hit share and get this information out there. So if they have a high interest car loan, there is hope for people with high interest car loans. Once you know how to read an amortization schedule, you can beat the lenders at their own game. We're going to go over a little bit of that today. So let's go ahead and get started here. I want to be able to thank you for joining us. Oh, next week we're not going to do the show because of the Thanksgiving week. And so there will be, we have six, this will be our sixth episode. We'll be replaying those episodes throughout the day on next Friday, so that you can kind of get caught up on what has been happening up till now. So let's go ahead and put the book on the screen and share. We'll share that, and let's see here, and double click that. There we go. You should be able to see that okay. All right. So again, you want to get this book. It's the only book of its kind that helps people to understand how loans actually work. I'm telling you, we're getting all sorts of comments on the book. People are getting the book, they're reading the book, they're very excited to get this information. No one has told them this before. People are watching the videos, staying up all night, watching the videos. This is what we're being told. People call me from all over the country and outside of the country, because now the P.I.L.L method is helping people in 9 different countries to date. And this book has been going like gangbusters for the last 2 months. In fact, we've gotten as high as #2 bestseller on Amazon in just 2 months. So what we're trying to do is get it to, obviously, get it to #1 bestseller. That would be great for my first book. But there's no other book like this on the planet. No other book explains how amortization works, or how we can attack amortization and do well with beating that beating the bank at their own game. Listen, once you know how to read an amortization schedule, once you plug in a computer, the OCC, the opportunity cost calculator into this thing, and I'm telling you, you can cut interest costs by 75%, pay off all of your debt in an average of 7 to 9 years is fantastic. So I just want to go over here and see who is in the room already. Oh, Ian Pedley from Australia. We have several clients in Australia, and Ian Pedley is a mortgage broker there in Australia, and he wants to share the P.I.L.L method with his clients. So thank you, Ian, for being here. I have no idea what time it is there in Australia. Why don't you tell us? What time is it there? So anyway, um, uh, I want you to get the book, read the book. It's in paperback and in Kindle. And if you get the paperback, you can actually get the Kindle at a reduced price, and then you can give it away to somebody. Let's see what else is go. Oh, if you go to the website and put in information, you get a free download of our information on how to track your budget. We have a budget software that is there for you. You get that for free just for buying the book. And then that will help you to gather all your information together so that when you want to get a free analysis, you will be able to get that and then get on the P.I.L.L method opportunity cost calculator and save all kinds of money and get out of debt in 7 to 9 years. So anyway, we are getting ready to get started here. And Ian said it is now 7:15 a.m. there. Well, it's now, 7:15 a.m. and he just got up. But thank you for joining us, Ian. We appreciate that. And hi to you and your family. Anyway, so let's go ahead and get started with what I wanted to talk about today. I just heard on NPR's Planet Money about what's called subprime car loans. Subprime, meaning you can get qualified for a car, a used car, but it's going to be at an interest rate that you probably will not like. But because of the financial situation that you're in, and maybe you have bad credit, maybe you have no credit. There are some people out there with absolutely no credit history. And I've talked to lenders, I've talked to people who work for dealerships. I talk to people who are mortgage brokers. I've talked to people who are real estate brokers and agents. And they tell me that the only thing worse than bad credit is no credit. So trying to live cashless and try to buy a house or a car is going to be just using cash and not using credit, rather, is going to be very difficult to purchase things unless you have all the cash available. What we're going to tell you is that cash is not king. A wise use of someone else's money is always better. So we're going to show you how to borrow responsibly, borrow cheaply, and borrow in a way that benefits your family. Because if you can borrow money and cut your interest costs down, you can take your money and invest it and make a lot more. I'm telling you, investing your money is more powerful than trying to pay for things strictly with cash. We're going to be able to talk about that more and more down the road. But let me go ahead and put this on the screen. We're going to stop share here, and we're going to put some information on the screen about the subprime loan. I'm going to play a little snippet, about 1 minute, from that podcast, Planet Money. And if you don't know about Planet Money, that's one podcast that I really do enjoy. They talk about all sorts of things when it comes to money. But one thing, I've listened to all of their shows. I've gone back as far as I could go back, listen to all their shows. Guess what they don't talk about? Not one show on amortization and how loans actually work and how to defeat an amortization schedule. So listen, let's do them a favor. When you hear this, find out their email address and email them some of the P.I.L.L method information and say, you need to have this on your show talking about how amortization actually works, how loans really work, and how we can cut our interest costs by 75%. And everyone should be out of debt in an average of 7 to 9 years, because we can cut our interest costs by 75%. Most people are unaware of how this really works. The only reason why you're aware is because you've probably been watching my videos for a good while, and you have a better understanding of it. But if you try to talk to your banker about it, your real estate agent about it, your accountant about it, your financial planner, they have no idea what you're talking about, because there are a lot of people who don't know how a loan works. So let's email Planet Money and say, listen, you got to get the book, you got to watch the videos, you got to get some of this information on, so we can broadcast this idea on how to eliminate debt in this fashion to the entire world. So email Planet Money, let them know. All right, so let me go ahead and put that on the screen here, and go over here, put this over there, and bring up Planet Money. There we go. And let's see, we're going to share. There we are. NPR, Planet Money, and we're going to play just 1 minute of this show. The show is called 3 Sides of a Car Loan, and I hope we're able to pick this up.
Of subprime auto loans for a second, because Stephanie was not going to get a favorable loan, to say the least. This was about a $12,000 used car. Her interest rate on the loan was going to be 23%. So with fees and taxes, her payment was going to be $466 per month for 48 months, and she was going to end up paying almost double the sticker price of the car.
Some people say this is why subprime is predatory, but others say this is kind of the deal. This is what it costs to cover a higher risk of default when someone has bad credit.
But these are the kinds of terms on subprime auto loans. Interest rates in the high teens, low 20s, and sometimes they'll be stretched out for 7 or even 8 years.
So Stephanie's looking at a car that's not her dream car and thinking, it's better than the shaky Ford Explorer.
She's looking at a loan that is definitely not her dream loan and thinking, I mean, I can't afford it. $466 a month. I make $4,000 a month. Okay, let's do this.
All right, did you guys hear that? So here are the terms that we just heard. $12,000 at 23% and a payment of $466 for 48 months. Now, even though this is Planet Money, I'm going to show you some things about this loan that we would take for granted just because we heard it, but we really need to check this out. Let me put this on the screen for you. And let's see here. And then we're actually going to start this thing over. Let me go here to cancel that. Brett Whistle, I'm gonna put it back in again for you, okay? And so we're gonna put in a $12,000 loan. This is at Brett Whistle. You can do this on your own. Oh, look here, I've got an ad here. Maybe, I don't know if you can see that or not. Maybe you're seeing something else. All right, So let me see here. We've got $12,000. Okay, $12,000. And what was the interest rate? 23%. Okay, and the term was 48 months. Okay, now the payment that we were told was $466. So let's take a look and see what it would be. It's actually $384.62 for 48 months. Put in $12,000 at 23% for 48 months. It is $384.62. How about that? Okay, so now where we're going to go down and take a look at, now what we heard was it was going to be almost double the sticker price. Well, it's almost, but when you're thinking double, 12,000 doubled is 24,000 or $12,000 in interest. When in fact, it is a lot of interest, but it is not quite $12,000. So we have $12,000 borrowed. The amount of interest total that would be paid is $6,461.76 if you kept the loan for the entire 48 months. Now, here is a thing that you also need to look at. At 23%, we're actually going to pay back 53.848% of what we borrowed. So it says 23%, but we're actually going to pay back 53.848% of what we borrow. And meaning this, if you borrow $1 from me, and then I say, pay me back $2, that's 100% interest, isn't it? Or if I say, pay me back $1.50, that would be 50% interest. So if I say, I'll lend you $12,000, but I'm going to charge you a little over $6,000 for it, that's a little over a half. 53.848%. So how do we call it 23 when it actually turns out to be 53? So folks, this whole thing about amortization, we need to really wrap our minds around it and really understand what's going on. Stick with the P.I.L.L method, stick with Finance Fridays. We're going to be getting into this thing deeper and deeper every single week. So let's take a look at this subprime loan and see what we could do about it, okay? So here we are. We have a payment of, what was that payment again? $384.62. And look how much goes to principal the first month. 300 and let me get my notes here. There we go. Get my clipboard. And let's see. I want to make this 384.62. 384.62. And out of that very first payment, $154.62 goes to principal, $230 goes to interest. So let's figure out what's happening here. So this is the money we get to subtract from what we owe, not the $230. That goes to the bank. $154 goes towards the car. $230 goes towards the bank. So we subtract the $154.62 from the $12,000. We're left with $11,845.38. Now, what happens next? Once we do that, then the bank takes this number and then does a multiplication, not by 23%, but by a different calculation using an amortization calculator, and then they come up with the interest cost on the very next line. And because you owe less, you're going to pay less interest. And on the next line, on line 2, the interest cost goes all the way down to $227.04. the difference goes over to the principal, and now we're paying 157.58 and 227. Now, how do we attack these loans if we have high interest amounts, so that we don't have to be afraid? If you get stuck in a high interest loan, how do you take advantage of it? How do you take the bull by the horns and beat this thing the best way you possibly can? So let's pretend that this first payment is in January. So we make that payment in January. Oh, by the way, you're going to need a calculator for some of this. So if you haven't got a calculator handy, pull it out. Use the calculator on your phone. So we're going to need it. I'm going to show you some things, okay? So $154 goes to principal, $230 in the very first month. And if we look, if that's January, our February principal payment would be $157.58. Now, here is the thing that you need to know. You don't need to wait till February or the next month to give the bank any extra money. If you apply any extra money to the loan, any money that you apply in the same month goes to principal. So let's just say you had an extra $157.58. Let's just say you did. All right. And if you did, you would make your regular payment of $348.62, and then sometime in the next month you would send to your lender $157.58. If you did, because you paid interest in January, you don't have to pay any more interest in January. All of this money goes to principal. You are immediately paid down to right here, $11,687.80 immediately. All right. And then remember, your month-end balance determines how much you pay on the very next line of the schedule. Your month-end balance determines what you pay on the very next line of the schedule. And if you're already paid down to line 2, then February's new payment is on line 3. $160.60 goes to principal, and $224.02 goes to interest. That's your new February payment. And because you did it this way, you do not now have to pay this $227.04. You just save that money. And you're squeezing that amortization schedule, so payment number 1 is now touching payment number 3. You got rid of payment number 2 for $157.58. Now, I'm going to show you some other tricks about this thing, but this is what you need to know first. All right? If you were to pay any amount would be helpful. And all we need to do is bring down the interest cost in any way that you can. So let's see how we can be a little inventive here, use a little ingenuity, and see how we can bring this thing down instantly. So what is happening? We are charged daily interest on car loans for the unpaid balance for the entire month. And when we allow the interest to mount for 30 whole days, so they take the interest rate divided by 30, and there's a daily interest rate. Did you know that? Okay. So when you figure that daily interest rate, it's just added on every day, and then you get an interest cost of $227.04. That's how they do that. It's 30 days of interest calculations on the unpaid balance. So what if you could do this? I showed you what could happen if you could come up with a full payment. But what if you could come up with a partial payment instead? Let me go ahead and try to put a calculator on the screen. And once the calculator gets up on the screen, then I've got my calculator on my phone, and I have to do a new share so you can see this. All right. new share, and there we go. You should be able to see calculator on the screen here in just a second. So I'm going to go ahead and pull up the my calculator on the screen on my phone here. And so we already discovered that if we pay $157.58, we would save $227.04. So let me put in the $227.04. Okay, 227.04, and if we do that, we can show how much we're saving if we have something less than $157.58. So I'm going to put $157.58 in my calculator, and I'm going to say, what if I only had half that money? What if I only had half the 157.58? So let me divide that by 2. That gives me $78.79. So if I have half the money, you realize I could save half the interest. So let me divide this by 2. That means I would save $113.52 if I could only pay put down $78 extra. What if I didn't have that? What if I had half that, half the 78? Let me divide my 78 by 2 again. I have $39.40, okay? 39.395, $39.40. So that would be half again. I just divide this by 2. That would save me $56.76 in interest I would not have to pay. So I'm going to do this again. So I don't have $39.39. I'm going to divide it by 2. I have $19.69. And then I would save in interest by applying $19.69 extra to my loan. It would save me in interest, divide that by 2. It would save me $28.38. So 19 bucks extra would save you 28 bucks in interest you don't have to pay. Let's do it one more time. Divide this by 2. I have $9.84. So you don't need much money to affect killing a lot of interest on these loans. So I would divide this by 2. And that would save me $14.19 in interest I wouldn't have to pay. So isn't that good information? So any amount going to the loan kills a lot of amortized interest you don't have to pay. And the more interest you eliminate, the faster you get out of debt. All right? The more interest you eliminate, the faster you get out of debt. So if you want to know more about how all of this works, just come on over to the P.I.L.L Method website, thepillmethod.com, and you can then sign up for a free savings report. You can get a free savings report, and then you can know the month, day, and year you could be debt-free and how much interest you could save. Let me look over here, see if there are any questions. And it says, aren't these car loans fixed rate, which don't allow extra payment? I don't know how it is in Australia, Ian, but in the U.S., you can pay off your car the next day if you want to. So let me ask you this. So a lot of people ask that, will the bank allow extra payments? And let me put it to you this way. Let's just say you made the first payment on this car, and you found a lottery ticket on the street, which was a winner, and you cashed that baby in. All right. So now you already made the first payment. And then so if you had enough money to pay off the entire, what would be left? $11,845.23. What if you had enough money to just pay that off the very next day? Would the bank accept $11,845.38 from you? Or would they give it back and said, no, you can't give that to me. We don't want that. We want you to pay it monthly. They will accept it. And when they do accept it, what happens to all these interest payments left over here? You got it. You never have to pay them. You save every single one. You would save the remainder of the $6,461.76 that they were looking for. And all you would have to pay in interest is the $230. That would be it. And you're all done. That's how it works. Now, let's go over another thing that I discovered along the way. When I first started getting into this, especially when it comes to car payments. Now, you do have to find out if your finance company or if your bank or whoever has your car loan will allow this, because some of these institutions, their software will not handle these types of payments, but most will. So all you have to do is ask. And if you get a no from the person who answers the phone, never accept no from a person who is not authorized to say yes. Go to a higher authority. Go to a manager. Keep going up the line until you get an answer that makes sense. Some people who answer the phone give you an answer, we just accept it, and find out that that wasn't true. So again, never accept no from someone who is not authorized to say yes. Okay, so here we go. Now, let's just say now this payment is $384.62. Let's just round that thing off to $400. Okay, rounding it off to $400. Did you know that you can ask if you can pay, instead of $400 a month, you could ask to pay $100 a week. Still same $400 a month, but it's $100 a week instead. So what happens if you pay $100 a week? Now remember, you're paying interest on the unpaid balance for 30 whole days, all right? But what if you have this balance, but you give the bank $100 in the very first week, and they apply it, some of that money, to principal? Now there's no way they can charge you for the whole 30 days on $11,845.38 because you will owe something less than that, right? So they have to charge you a smaller amount of interest. And then the next week, you give them another $100. And now they have even less. And so they charge you another week for a little less interest. And then you give them another $100. And then that next week, they charge you a little less interest. And in the final week, you give them the last $100. And it's applied to principal and interest. And what happens is, because you paid less interest, your interest cost will be less than $227.04. So out of your $400, more of your money would go to principal. Just by paying that $400, not paying it once a month, but by paying $100 a week. Isn't that great? I found that out. And what started to happen was the next month, our credit union sent us a bill, and it says, you don't owe us the whole $400 this month. You owe us something less than that. Don't fall for it. Continue to make the regular payment, because when they ask for something less, what they're trying to do is recoup the interest you just saved. So don't pay the smaller amount, continue to pay the full amount, and continue to pay it every week. Now, your mortgage doesn't work like that. So don't try it with mortgages. You have to know the rules to what loans you're using, and you have to know how the bank will accept money on these loans. So a car payment works this way, but A mortgage does not. All right, remember that. So there are other ways to save interest on a mortgage. Well, and hopefully we'll be able to talk about that at some time, or watch one of my videos, or give us a call at 256-886-1867. That's 256-886-1867. And then we'll go into get you a free savings report. You get a free class, and you get to understand how all of this works to pay off mortgages. Now, back to this. What started to happen is that eventually we didn't have to give the bank a full payment. We got down to half a payment, but we kept paying it this way, Pretty soon, we didn't owe them a payment at all for the next month, but we kept paying $100 a week, $100 a week, $100 a week. And then we got 2 months ahead. Eventually, we got 3 months ahead. Eventually, we got 4 months ahead, paying the same amount of money, paying the same payment, but we broke it up into 4 separate payments, 1 per week, lowering the interest cost so more of our money would go to principal. This is what interest cancellation is all about, folks. How can we use the same amount of money to kill these loans? Now, remember, this is a subprime loan, and the interest rate is 23%. And listen, even after 1 year on this loan, we pay the principal down by $2,604.09, but the bank wants $2,551.35 in interest. So if we can do a combination maybe of 4 payments a month and then add in extra principal, we can knock this interest down. Instead of paying $6,000 in interest, if we're careful, we can get this down with relatively small amounts of money. We can cut that interest cost in half. In half. So we can turn a 23% loan into more like a regular loan just by learning how to read an amortization schedule. Now, here's another thing you want to know. Sometimes people are in a position to put a large amount of principal down as a down payment on the loan, trying to get the loan smaller, the payment smaller, or trying to make sure that we don't pay a lot of interest by making a down payment. All right. So instead of having a $12,000 loan, we start out with an $11,000 loan or a $10,000 loan. Okay. So let's just say we had an extra $2,000. All right. Somebody gifted you something. You got an extra $2,000. So you're going to put it on your car loan to help yourself out. And make a down payment on the car loan so you can start out with a $10,000 car loan. So here's what you never do. Never put it as a down payment. Hold your $2,000 back. Get the regular loan, and then apply your $2,000 to principal. Watch what happens. So remember, we're starting out with this payment. And if we look here, we can see that we can have cumulative principal and cumulative interest. These 2 columns add up the principal and interest for you. So if we make our first payment and then take the $2,000 that we got as a gift, and we didn't make a down payment with it, but now we use it as a prepayment, we give it to the car company or our finance company, and look here. Here's a total of $2,064.09. We would be paid all the way down to here in 1 month. We still owe about $10,000. You see that? $9,935.91. but we knock a year off of this loan with that $2,000. Why would we use it as a down payment and pay it for the full 48 months when I can use it as a prepayment and turn a 48-month loan into a 36-month loan instantly? How about that? Using the same money. Now, take a look at this interest saved. $2,551.35. All right. And we would subtract the $230 from it. So we save $2,221 in interest right now. Right now. So we can knock $300 off of the $6,461.76 that the bank wanted us to pay. How about that? All right. So let me put that back on the screen. I'll put my calculator back on, and we'll do a little math on that, and then we'll move on to the next subject. All right. So I have to do a new share so you can see the calculator. There we go. Put the calculator on the screen. There we go. So here we are. So we have 2,551.35. We're going to subtract the $230 in interest we paid on line one. Okay, we have to do that. Minus $230. That leaves us with $23.21 in interest that we just saved. Now we're going to subtract $23.21.35. We're going to put our total amount of interest that the bank wants for the 48 months. That would be $6,461.76. And we'll subtract the $2,321.35. Okay, that leaves us $4,140.32 instantly. We knock a ton of money off of that by making prepayments instead of down payments. Never, ever, ever, ever make a down payment to a car payment, to a car loan. Some people who have the unfortunate situation of totaling out their car. They get a check from the insurance company. They have to go get another car, and they make the mistake of making a down payment with that check on the car loan instead of holding it back, making their best deal on the car loan, and then taking that check and make a prepayment to that car loan and knock a year or two off of their entire loan. And here's another thing that you want to do, folks. Always get a loan for the longest term possible and pay it off early. We're going to show you all of these tricks on how to save money, how to get out of debt faster, all because the P.I.L.L method is right here for you. And we've discovered all of this, and we're going to make it known to you. Here is a ton of free content that you can use right now. But if you use the calculator, the opportunity cost calculator, you can save even more. So in the last few minutes, I'm going to bring up the opportunity cost calculator on the screen. So let me go and put that up. Let's see here. And then we're going to give you some examples of what this powerful machine, you've heard about it. We're talking about P.I.L.L method. P.I.L.L stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. And we're going to show you how all of this comes together in this calculator that is designed to save you money. Okay? I got to get a little something to drink there. Oh, look at that. You weren't supposed to see that. That's what you do for doing Facebook Live. All right, here we go. So, I've got to log in here to pull that up, and then I'll put it back on the screen, okay? So here we go. All right, and it's almost there, and we're going to go ahead and reset everything just like that. Then we'll put it on the screen. Okay, and there we are. All right, so let's bring it back. Let's bring everything back. So now you can see my screen again. And there we go. Share, and there it is. All right, this is John and Rebecca Jones. And what we're looking at is their action plan. And in the action plan, you have all of your income and all of your outgo, all of your bills, all the things that you have to pay. And the program tracks all of that. And that's done in action plan. Then you have a budget tab. That's where all of your income comes in, and you put in all of your bills. So right here, there's your income coming in, and we'll put in the bills. I just have a few bills in here. I didn't have time to put a whole lot in. There's just a few things in. But what I did, I itemized a couple of things, and then I put in an unitemized budget for you to make up the rest. All right, so we go into accounts, and then we get to see that John and Rebecca Jones have $500 in checking, $5,000 in savings. They have a $25,000 auto loan. They have a $2,000 Visa and a $200,000 at 6%. This really means, this 6% means that the bank wants them to pay what, 115.838% of what they borrowed. The bank wants in excess of $200,000 interest on this loan. They're not going to get it because we can see up here already that with the opportunity cost calculator, we've already calculated their interest savings to be $179,395.62. And without changing their budget, they will be out of debt because they're saving so much in interest. They'll be out of debt in 7.7 years. And here's their new payoff date. Not 30 years from now, 7.7 years from now. Let's go into the action plan and let's see how all of that's done. So John, we're in September, and we actually can see 3 months at a time: September, October, and our current month of November. So we're going to back up 3 months on this thing so that you can see what's going on. So on September 1, John got paid $950. So when John gets paid, we just click execute here, tell the program that John got paid $950, and look at his how we categorize this. All right, he gets paid by commission. So it could be $950 this week. It could be $1250. It could be no 50. I mean, sometimes when you're working commission, you don't get anything. So we would just tell the program the truth, just like financial GPS. You just give the computer the data, and it recalculates everything. So instead of $950, we would just put in $0 and hit execute. And then the program says, oh, I didn't get any money this week, so let's recalculate all of our findings and all of our recommendations to John and Rebecca Jones. So instead of that, we're going to put in the $950, and we hit execute, and then the income disappears from the screen because that $950 got added to their virtual checking account. They account inside the program, which matches what they have at the bank, dollar for dollar, penny for penny. This program must know what you have in the bank so it can make recommendations to you. All right. So we're going back to the action plan, and we have enough money in savings now in our checking account to pay the mortgage of $1199.10. All right. We also have enough money to pay the utilities of $200. Once we do that, now Rebecca on the 5th of the month gets a $700 check, and we deposit that into the program as well by clicking on it, and it matches what they have in the bank. So guess what? If we do everything like the program says we should, as soon as we get the money, we report it. As soon as we spend some money, we report it. Then the program will learn your spending habits and say, oh, on the 5th of the month here, we're going to take money from checking and put it in savings, $100.90. Okay, $100.90. Now, why are we doing that? The program says we're going to put all of your money away that you don't need for, catch this now, first goes in the money that you need for your monthly bills. So that goes into the program because we can't use that money. Then next is the payments you need to make minimum payments on your loans. You got to make at least the minimum payments on the loans or people start coming to get stuff. Don't want that to happen. So we put that into the program. Then we're going to put some money away for savings, your 401k. You're going to talk to your investment counselor, and I hope you're talking to the P.I.L.L method wealth building team, because we're helping regular people become millionaires with the interest money they're no longer paying the bank. We're helping them to invest it at an average of about 7%. Oh my gosh, it is fantastic what this thing does. But anyway, so now we're putting away investment money, not only for retirement, but also for your child's education. So we're putting that money away. And the last bit of money we're putting away is your fun money, money for lifestyle, money for vacations, money for date night. We want you to have fun along the way. No one wants to be in a situation where they are living an austere lifestyle trying to get out of debt. Here's what I know for sure. If someone who is trying to lose weight is always hungry, I can almost guarantee you they won't lose a pound. If you're trying to get out of debt and you're trying to restrict yourself not to go anywhere, not to do anything, drive a 50-year-old car into the ground and not have anything, I guarantee you most people will break that diet. That debt diet, they'll break it. So what we want to do is put in your lifestyle concerns so that you can live an enhanced lifestyle on the P.I.L.L method. Okay? So we got an enhanced lifestyle going on. Remember, we're making the regular monthly payments for the bills. We're putting in the amount of money for our loans, the minimum payments. We're putting away money for savings, and we're putting money in for fun. That's all in the program. So what's left? There's some money left over. We're going to optimize the use of that money left over after all these other things are done, after you've had fun, and start to kill interest with it and get out of debt. So we put that money in savings and hold it until the right time. So we're putting $100.90 in. Then we get another paycheck after we pay the phone bill, and we're going to put $388.72 in. We're going to look at the date. The program tells us take it from checking, put it in savings, $388.72, and then we tell the program that we did it. Okay? And so we would click execute, tell the program we did it, and then it adds it to the program. Now, here is the interesting thing. Why is the program telling us to wait to put the money on debt and making minimum payments to all of the loans in September? The reason why is because the program is trying to wait for the right time and the right amount so that you can maximize your interest savings. This is a program that optimizes all of your money and says, we want to make sure you get the biggest bang for your buck. We just don't want to throw money at principal willy-nilly. We want to make sure that when you do, you're getting the most interest savings per dollar applied to principal. And that changes every time the amount changes, the day changes. When Huntsville Utilities charges you differently, that target amount is constantly moving, and you need to do thousands of calculations to make sure you're always getting the biggest bang for your buck. All right. So when we move down into October, we're seeing the same thing. Putting money away, putting money away, putting money away. Oh, that is the big money though. What about the small money? You know, I believe in picking up pennies in the parking lot. This program will show you how to pick up money in the parking lot, meaning we're going to gather up the fragments that nothing be lost. And by gathering up those fragments, the small amounts of money here and there, and applying them correctly, you could end up with 12 baskets full of interest savings. How about that? A little biblical reference there. So here's what we're doing. So let's say that the utility bill, which normally would be $200 a month. Oh, first of all, let me tell you that the program is already calculated. I'm going to change this up here to the next debt transfer. Even though we're starting out in September, the program is already calculated by November 7th that we should have $3,119.80 to put on debt by then, out of savings, not cutting out your fund, not cutting it out of your budget, but just for money left over after everything else is done. How about that? All right? Live well and get out of debt and build your savings. I'm telling you, it's fantastic. So here's what we're doing. So we've got $3,119.80, but we have $200 for the utility bill, and the utility bill is only $150 this month, which means we are $50 under budget. So what does the program do with that? We don't have to think about it because we already have a fund budget, right? So the program says instead of $100 going into the bank, we're going to put $150 in the bank, and we're going to increase the amount that we can put on debt by $50, and we're going to increase our interest savings to a significant amount because of that $50. If you knew, let's say your $50 is worth $250 worth of interest you don't have to pay on that mortgage. Wouldn't that be great to know? Oh my gosh, that's a lot of money in savings. So let's take a look at what's going on here. All right, so we're going down to the unitemized budget, and in the unitemized budget is some fund money. So we've told the program that we're going to be spending an extra $1,300 a month every month for the next 7 years, and we can still get out of debt in 7.7. But what if we find out that we're not spending all of the $1,300? What if we discover we're only spending about $1,000 of it? We would have to go into the budget item and make a change. So instead of paying $1,300, we're paying about $1,000. Watch what happens instantly when the calculator starts to do its thing. as we're spending $1,000 a month instead of $1,300 a month, watch your 7.7 years and your $179,000 in interest saved. We immediately go to $186,000 in interest saved. And now we're out of debt in 6.9 years. 6.9! Fantastic. Knocks off almost a year just for $300 a month we're not spending. So, or because we know how this affects long term, we could say to ourselves, I could get out of debt in 6.9, I could get out of debt in 7.7, I could spend an extra $300 a month on something. Let's take an extra vacation and get out of debt in 7.7. So if we wanted to, we could put the $300 back, spend all $300 a month, spend an extra $1,300 a month, and still get out of debt in 7.7 years and save $179,000 in interest. Wow. So let's go back to action plan. We've gone all the way through September, all the way through October, and now we're down into November. All right? So now we're going to take a look at what the program is telling us to do by November 7th. It says take money from savings because it was already there and apply it to the Visa and pay it to zero. Wow. Not pay a little bit extra every month and pay it off in a year or a year and a half, just like it's being taught to us, by some others. But if it's in the savings account, let's take it out of the savings account, bam, and apply it to the Visa right now. When we do, guess what happens? The program will then do a calculation for us and let us know some valuable information. So let me go down here and tell the program we want to pay the Visa. And we have an interest cancellation calculation, and our future interest savings right here, $1,736.34 for paying off the Visa now. Meaning, if you were to pay the Visa off in 1 month, okay, pay the Visa off by using minimum payments, then you would also have to give the bank an extra $1,736.34 to do it. But since you took money out of savings, put it to the Visa now, that's $1,736 you don't have to pay, and you get to save that. You get to do whatever you want with that money instead of giving it to Visa. So let's go over here to this screen and see what we have here. Any other questions? All right, there we go. All right, so there you go. So that's how we do that. So now let's go into, I didn't have any new questions. So what we're going to do is go to the next thing. So after we pay off the Visa, let's go back down into November and look at what the program is telling us to do next. Now this is interesting. The mortgage is due on the 1st of the month. So John and Rebecca Jones paid their mortgage on the 1st of the month. But then the program says wait 6 days and then put an extra $1,166.98. Not rounding it up, not doing anything extra, because it would be easy to round that 98 cents up to the next dollar, or the $166 up to the next $200, only because they have extra money in the bank. They have over $5,000 in the bank, and the program is only telling them to spend a little over $3,000 to put on debt. Because the program is designed not to violate the law of diminishing return. There's a point at which more is too much. By putting it on at this particular time, we have to put down a specific amount on a specific day and kill the maximum amount of interest we can per dollar. Let me show you what I mean. So when we go in here, this is going to be our last example. All right. No, we got one more example after this. So we've got $5,657. I'm sorry, $5,675.26 in interest savings because we apply 1166.98. If you knew that by applying this amount you could save this much interest, would it be easier to walk by the big screen TVs in Costco? All right. Wow. Let's go back down here and let's apply this money. So we're going to go down here and make the application of $1,166.98 and save this money. Although I might think I'm a little smarter than the average bear. I got more money in savings. Why don't I just do this? Change this to $1,500. The program would then change to $7,259.77. All right? And then you can then see how much interest you save with this much money. And you say, oh, program says wait until the 7th. Let's not do that. Let's pay it on the 1st. Send it in like everybody else with the regular mortgage payment. So we're going to pay more and we're going to pay it sooner. But remember, the program says, here's your optimum amount of interest savings, $179,424.34 by following the program. But we're going to go outside the program and see what happens. We're going to click on execute and do what we want to do. Watch the 424.34. The 424.34 becomes $389.48. We actually end up saving less interest because we're paying more and paying it sooner, but we're paying more at the wrong time, in the wrong amounts, and probably to the wrong loan. Let the program guide you. Because here, let me show you something. If you go over here to preferences, this is great, and program focus settings, and you see the program is set to automatic. When the focus is set to automatic, the program will automatically optimize the order you pay off debts to become debt-free. You may change the focus setting. However, this could have a negative impact on your overall results. So let's go back into accounts and see what just happened. The program already told us to pay off the credit card. All right, that's the first thing it tells us to do. So once we pay off the credit card, then we have $50.88 left over. What would happen with that $50.88? We don't have to pay it to the credit card anymore. If we are thinking classic snowball theory, then we would apply that money to the auto loan because it's the next largest loan, correct? And then when we would focus on the auto loan and pay it off sooner, and then take all that $500 and apply it to the mortgage and knock that mortgage out faster. And that's how we've been taught to do it. But let's go back into the program and figure out, is that the right way that we've been taught to do it? Okay, so let's go over to program focus settings. It's set to automatic, but we want to say, you know what? We want to set it to snowball theory. We want to go and focus on the auto loan and override the automatic setting. Watch your 7.7 years, watch your $179,000 in interest savings when we override and tell the program we want to focus on the auto loan and pay it off maybe 2 years early. What? It's actually going to take us longer to get out of debt by paying off the car early, and we were saving $179,000, and we just lost. We paid off the car early, and it ended up costing us $2,000 in interest more. Why is that? Let me show you why. Going back to the budget. Going back to accounts. Because we chose to attack the wrong loan at the wrong time and in the wrong way. With this program, the car is still going to pay off before the mortgage, but we focus solely on the car. And what happens is, if you can see here, we have interest amount of $83.33. That's the interest cost on this car. So as we are attacking the car, all of our focus, all of our energy, all of our money is going towards this car loan, okay? And as we do that, guess what happens? So we are, as we're focusing on the car loan, we're paying minimum payments on all of the other debt. And when we take a look at this mortgage and open it up, we see that the mortgage interest cost is $992.50. Folks, does it make sense to totally focus on a loan that only cost us $83 and totally ignore the loan that's costing us $992.50 a month? When all we have to do is come up with an extra $206.60, apply it to principal early, and save nearly $1,000 in interest. It is just that easy. And this is why we end up paying, when we use the snowball method, the average family will end up paying $30,000 to $60,000 more in interest than they need to pay, because we're not paying attention to interest cost. We may be looking at interest rate, but we're certainly not focused in on interest cost. That's what this program does, folks. It makes sure that you are making the right moves at the right time in the right amounts and still live an enhanced lifestyle. Well, folks, that's it for this week. I hope you enjoyed the show and learned some things. We're going to put to take us out. Remember, this is the book that talks about that. This is the book that talks about how to save this money so you don't make the mistakes. We're not following the advice of the experts anymore. We're not following the advice of the gurus anymore. We're actually starting to do some math and know how important math is in getting out of debt. And we now have a calculator that does all of the math for us and tells us exactly what to do, how much money to move, what month to move it in, what day of the month to move it on, and which loan to attack. One last thing about the debt snowball. If you are attacking a particular loan, you know that as you get deeper into the amortization schedule, the interest costs get smaller and smaller and smaller. Why would you pay a loan all the way to zero when the interest savings are so tiny? Why not attack a loan until it's less expensive than another loan and then switch over to that more expensive loan now and start attacking it? This way, you get to save the most amount of interest possible. This is what the program, this is what the opportunity cost calculator can do for you. Folks, give us a call at 256-886-1867 or go to our website, thepillmethod.com, sign up for a free savings report and a free class, and who knows, you might be able to have your class even with me. Listen, I'm looking forward to seeing you in a couple of weeks. Enjoy your Thanksgiving, and we'll see you next time. Thank you for being with us. Hope you enjoyed the show.